Our track this afternoon focuses on some very current topics. If you were listening to Monica DeCenso's presentation earlier, she talked about SPACs, and we're going to learn what SPACs really are and how they function. That's going to be our first presentation today. Then we'll hear about early stage financing from some experts in that field, and then learn about some local resources that are available for funding early stage companies. Before we start our first panel this afternoon, I want to recognize our finance track sponsor, Tanner LLC, and ask Sean Marchant, who is a tax principal at Tanner, to say a few words. So Sean, take it away.
You're on mute, Sean.
Sean, I think you need to unmute.
There we go. I thought they were going to unmute me. All right, here we go. Okay, sorry about that. Hey, so thank you, Kelvin. We're delighted to be part of BioUtah and continue to really be amazed with the development that is occurring in the life sciences community, all the new innovation that's coming out. For those of you that don't know about Tanner, we are Utah's premier public accounting firm. We provide the variety of public accounting services you would expect, from audit and assurance through domestic and international, state and local income tax consulting and compliance. We also provide transaction advisory services. So if you're looking to do a deal, be acquired, we can assist with that. And then we have information security and other advisory services. We also have some professionals that are specifically focused on the life science community, so medical device, pharmaceuticals, and the like. And we serve clients ranging from small startups to large multinational corporations. Our motto is we help best-in-class teams realize their full value by providing them with the right answer right here. And I think that syncs very nicely with the objectives of the Life Science Summit. And so toward that end, we're grateful to sponsor the finance track and look forward to hearing from this group of deeply experienced professionals and life science veterans as they too provide information to help Utah companies achieve their full potential. Lastly, I'll note that if anyone has any questions, we'll be here throughout the afternoon, so feel free to drop us a line. Back to you, Kelvin.
Thank you, Sean. We really appreciate the support of Tanner, not only as a sponsor of this particular event, but as a member of BioUtah and a significant part of what we call the BioHive. So thank you. I'd now like to introduce David Dobkin. David is a Utah resident and CFO and Managing Director with LifeSci Capital. To kick off the first panel entitled, "What is a SPAC and how do they work? Something we'd all like to know." So David, take it away.
Thank you very much, Kelvin. Thank you, Tanner. Thank you to BioUtah and the BioHive. I'm very excited to be here today. As Kelvin just said, I'm David Dobkin. I am the CFO of LifeSci Acquisition 1, CFO of LifeSci Acquisition 2, and a director of Petra Acquisition. And I'm also the managing director for LifeSci Capital, which is an investment bank that's focused on the life sciences. I'm going to be your moderator today to walk you through what we're going to be talking about with SPACs. This is a particularly timely topic that we're talking about. SPACs have really exploded up onto the scene. There were 298 deals in SPACs last year, or new IPOs and new issuances, raising about $83 billion. And through the first 6 weeks of this year, there was $38 billion raised and 128 SPACs that IPO'd. So that's almost half of what we did all of last year in the first 6 weeks of this year. So it's a very exciting time for SPACs. My involvement in SPACs, has been a CFO of several SPACs myself, and as a director, I've seen deals both from the inside and the out. We also advise on SPAC deals themselves. And one of the deals that we were an advisor on is are going to be some of the panel members that we're talking to today, being Clene Nanomedicine and PwC and Kirkland and Ellis, who all advised on their transaction. I'm very pleased to be here today And I'd like to now turn it over to allow for the panelists to introduce themselves, and we'll start with Mike Bellin.
Yeah. Thanks, David, and thanks for having me. Mike Bellin here. I'm a partner in PwC Deals practice. I lead PwC's IPO SPAC practice nationally, and over the last 24 months, with the rise of the SPAC that David mentioned, has been working with a lot of different companies out there, and with Rob and his team at Clene and across the Utah ecosystem as companies explore public exits. What does that mean? So I'm really looking forward to the conversation that we're going to have today. Don't be shy. If you have the ability to ask questions, please do. We're here for you. So thanks for that.
Great. Over to you, Rob.
I'm Rob Etherington, the CEO of Clene. As Dave has noted, we just took Clene public on December 31st at a SPAC transaction, which everybody on this call assisted that journey. Clene is now an 800 roundabout $1 million market cap company, but was entirely private for the previous 7 years we've been here in Utah. And within the course of the next year, we will find out if our clinical programs are successful in ALS, and then subsequently after that in multiple sclerosis as well. So it's been a fantastic adventure. I'll speak to the SPAC granularity a little bit later, but before being here at Clene, I was at Europe's largest biotech, Etherington, responsible for the US business on the commercial side, and before that, Pfizer. Dave?
Great. Thank you, Rob. Ben?
Yeah, hey, Ben James. I'm a partner at Kirkland and Ellis. I'm actually based in our Hong Kong office, though I'm sitting in the US at the moment in the same time zone. I'm in Denver right now. I think I'm in Hong Kong because, but I'm part of this panel because I've been working with Clene for a while. They were considering some Hong Kong transactions, and then when they started doing the SPAC process, it was kind of a natural for us to be involved because we at Kirkland have had a large number of SPACs that we've been involved in, both representing the issuers as well as the underwriters. And then on the actual de-SPACing merger transactions, we've also done a ton of deals representing both the actual targets that are being acquired in the SPAC transaction, as well as the representing the SPACs themselves, including Clene and their de-SPACing transactions. So thrilled to be here and look forward to talking with everyone on this panel.
Excellent. Thank you all panelists for introducing yourselves. As everyone can see, we have a stellar group. Given that we all have some SPAC experience, why don't we just start off why each of you can give a little bit of background about SPACs in general and any some key points to take away, and then I have some questions to help with the conversation. So Mike, do you want to start with some high-level SPAC knowledge?
Looks like Mike's frozen, Dave. Should I jump in?
Go for it.
Okay. So special purpose acquisition companies is what SPAC stands for. And this is a company formed to raise capital in an initial public offering, but the purpose is to use all of those proceeds to acquire one or more unspecified business or assets eventually after the SPAC original IPO. So there, Dave, Mike, you've just joined us. So I'll just keep going there and you can repeat through this. So a SPAC goes classically through the typical IPO process. It files a registration statement with the US Securities and Exchange Commission, deals with all those comments. It undertakes a roadshow for the underwriting commitment, but then all those proceeds are held in trust until a target company is identified, such as was the case in Clene's case. So Mike, you can chime in now that your system's back.
Yeah, so sorry about that. The joys of technology. The SPAC phenomenon, I think Robbie summarized it there really well. Is SPACs raise a pool of funds and they go after a target in a certain sector. I think some of the things that you typically see in a traditional IPO path, which many of you may be familiar with, it's a good way for a lot of the life science companies out there to raise capital, are very similar to the SPAC path. However, there are some nuances with periods that have to potentially be presented, some of the pro forma requirements that go into your proxy S4, and just overall preparation that we see for being a public company is by and large pretty similar, whether you're thinking about a SPAC transaction or a traditional IPO. And that's where we've seen management teams like Rob's team put in the efforts around public company readiness and preparing themselves for life as a public company and thinking about the infrastructure, people, processes that have to be in place to operate once the SPAC transaction happens, because they move pretty quickly. So a lot of the areas around accounting, financial reporting, around governance, around tax structuring, et cetera, that you think about in any going public transaction are very important when you're thinking about any SPAC transaction. They move quickly. I think that's, I'm sure the panel will talk through some of the, the benefits out there and what you read about in the marketplace, but they do move pretty quickly. So that readiness and that ability to prepare yourself for life as a public company, and in our eyes, and the auditor's chair in many of these cases, is really key for success.
In fact, Dave, I think it's probably worthwhile an exclamation point on what Mike just said, that one has to be already orged up pretty well for an IPO, which includes, as Mike's just noted, a PC AOB opinion from a solid accounting firm, ready and kind of prepared to go public in a classical way. And frankly, equally important, I think, on the legal side is that your S1, in this case of a SPAC, is already in progress of drafting. If you're not actually ready on the accounting side or on the legal side with what will end up becoming your proxy and all subsequent SEC filings, then it's very difficult to get orged up and competitive if a SPAC was to reach out and consider you as a target company.
Great. Ben, did you have any other follow-up with that at a high level on SPACs?
Yeah, no, completely agree with what Rob just said, especially about getting ready. In fact, one of the challenges, and we can, I think it'll be appropriate to talk about this later as well, but one of the challenges with the SPAC is that traditionally the SEC has treated a SPAC as, or the company resulting from a SPAC transaction as not being a new IPO company, but rather they consider in terms of timing for how quickly you have to have a fully independent or a majority independent board, a fully independent audit committee, a number of the corporate governance requirements, as well as a few other more nuanced laws. The SEC takes the view that the IPO of the de-SPAC company actually took place at the time the SPAC went IPO. So if the SPAC has been public for a year, at the time of the de-SPACing transaction, as the SEC views that original SPAC IPO that took place a year ago as the timing at which all of these other various requirements begin calculating from. So in other words, an IPO company would normally get a 1-year grace period on a number of corporate governance matters, but a de-SPACing company, if the de-SPACing takes place more than a year later, will have to be ready to be fully compliant with a number of SEC requirements from day one. So that can be a challenging. So completely resonate with what Rob just said.
That's definitely very helpful. Thank you for all of you for getting us started on this discussion today. I think we got a little bit into how the sausage is made, which I think is very important, and anybody who's considering a SPAC process really needs to know. But I think that this panel, and given our audience in Utah here, I think a great question for us would be, why is this a good vehicle? What are the advantages of going public via a SPAC versus some of the other routes to the public markets?
So they all start that one, because I think it's important we add one more piece of the sausage, to quote you, and that is that all these IPO proceeds that are part of the SPAC are held in this trust account, and that trust account just sits there, not prepared to be released to fund the upcoming business combination with the target companies such as Clene until the moment of signing, and then all of the SEC relevant pieces are enabled for the business signing. So to Dave's question, the advantage for a company such as Clene, who had contemplated going public in a classical IPO probably in about a year from now, actually, or at least the end of this year, we accelerated that go public transaction by 9 to 12 months. And so a SPAC becomes a slightly more efficient, not necessarily cheaper, but slightly more efficient method to get to the public markets. And if, and then is thus able to leverage the advantages of the public markets and deal with the disadvantages, because, one's going to be there anyway if one was planning the IPO. So for Clene, it worked out just to accelerate this journey. And in the end, though the first month is maybe a little messy for various reasons we can get into, in the end, you're almost at the same place that you would have been in an IPO, but a year earlier, possibly, or many months earlier.
Yeah. I'll lean in on what Rob just said there. I think some of the advantages that we see out there when folks are considering, do I raise private capital? Do I do traditional IPO? And what's the SPAC mean for me? It's the speed to market that Rob said. Through the SPAC IPO, they have the funds in hands. They have a lot of the quote unquote, public items in place, such as a public committee charter for the audit committee, et cetera. So some of the plumbing is in place with the SPAC already. So things may just move a little bit faster. The other advantage is just the amount of proceeds you're able to raise. I think we've seen a lot of life science companies go out there, and you don't only look at the cash and trust, but the PIPE process. The PIPE process, the market is open on a lot of these pipes where you have other private investors on the buy side looking to inject capital into the target company upon the de-SPAC transaction. So the ability to raise additional proceeds in addition to what's sitting in the trust account, I think is a huge factor for the process here. Those to me are the two biggest advantages that I hear are kind of just the speed at which these move, which, as we said at the outset, could be a disadvantage. You need that preparation, but really, the ability to raise a substantial amount of dollars to really fund your R&D program over the course of the next, 12 to 36 months is really key for a lot of the targets out there.
So Dave, Mike just mentioned a new word, PIPE. Maybe we should have Ben comment on PIPE.
Yeah, I'm glad he did, because I wanted to spend a minute to talk about pipes in the context of why it's an advantage. So a PIPE stands for a private investment in public equity. And so what happens is at the time, if you're let's pretend you're a private company and you get approached by a SPAC for a potential merger, you're negotiating an NDA, you're beginning that process with them. At the same time, you're also going to be reaching out to a number of large institutional, private investors, and they're going to start the process of kicking the tires and looking at the company, and really, especially during the past few months, as this market has evolved, these PIPE investors that are willing to come in and inject large amounts of money, often larger than the SPAC itself, in the hundreds of millions of dollars in some instances. They've become increasingly important to this whole process. They're especially important with the valuation process, because that's really the first time in which a company is able to put itself in front of a large number of investors and start presenting itself as if they are a public company, and you get the feedback, and it's very critical as the SPAC itself starts to consider, how am I going to value this private company, to get that feedback from the PIPE investors. And that also allows a private company, as they're considering a SPAC and considering whether or not, do I merge with a SPAC or do I do an IPO process, all of that PIPE process takes place confidentially, outside of the limelight. You haven't put up any public filings. You haven't really committed to do anything at that point other than consider a SPAC transaction. So what we're seeing is the PIPE investors become important because they allow this private company to get real feedback on what their valuation would be on a public company, so that they can at that early point make the decision, is this valuation something that I am happy with and that I'm willing to go to market with and be a public company at this valuation. And that's very different from the IPO process, in which you first start negotiating with banks, you prepare your registration statement, you file it with the SEC, and it takes several months before you're allowed to actually go and market the deal in the roadshow. At that point, you've already made public filings, you've already invested millions of dollars with accountants and with lawyers and with bankers. And so you're really able to take that valuation process and move it much further forward before you've incurred all these expenses and before you've made any public filings. So we're seeing PIPEs becoming a much more important process in the de-SPACing transaction.
Great. Thank you very much. All valid points. One thing that I think that everybody would like to consider is, what do SPACs look for in a target? And, what should targets look for in a SPAC? How does this marriage come together? And how does one company approach the other in this situation?
Yeah, so I think I'm taking that one. I think some of the things we've already hit on is how ready is, if I'm a SPAC, I want a company that's going to be, ready from day one. Do they have their financial statements in order? How ready is the management team for the limelight of being a public company? How easy is it going to be for me to sell this to my current shareholders? Because as we mentioned with the SPAC, when they do their IPO, they take this money, they put it in a trust account, and that money in the trust account can only be used for two purposes. One, for the SPAC transaction itself, for the merger transaction, but also it can be used for redemptions. If the SPAC investors, the SPAC shareholders, do not like this target, they are going to vote in favor of redemption. They're going to get their money back out of the trust account. And so if I'm a SPAC, I'm looking for a target that my shareholders are going to be comfortable investing in. So I think that's kind of the main thing that the SPACs are looking for. If you're a potential target of a SPAC transaction, I think one of the things you care most about is, what is the investor base of the SPAC? Or is it a bunch of fly-by-night guys that are just in it for they're hedging, or they're some other ulterior motives, or are these going to be long-term shareholders that I can work with going forward? And also, what type of role do I want the SPAC to play going forward? Are these guys that understand my business? Are they going to be able to help me going forward if that's what I want? Or do I want someone who is just going to give me some shareholders, give me some cash from their trust account, and then they're going to get out of it and leave me to manage my company on my own? And every company is going to have to make their own decision on that. But those are some of the decisions that I think SPACs that are potential targets should be looking for.
Great. Thank you very much. Any other, anybody else want to add to that, or should we move forward?
Pretty complete.
Great. So Ben, how about, you did touch on this a little bit earlier, but Mike, maybe this is a better question for you. What should a target really consider? You did touch on the audits and the stuff. Anything else that is high level or even more granular that the target should be looking for?
Yeah, absolutely. So Rob mentioned the PCAOB audits that have to get done. It's either 2 years or 3 years, depending on the target company and the SPAC, how many years you need to include. I would never underestimate that. It's a significant lift. You're looking at, your accounting policies and revisiting those in the public limelight. You're looking at incremental SEC disclosures that are required for that filing, in addition to additional testing by your auditors to get to that PCAOB level. In addition to the audits, there's the reviews. You're going to have to put quarterly financial statements out there in the S4 process. So making sure that you've gone back in any periods that have to get presented, you're quarterizing your historical financials, and you're doing that on a go-forward basis, and you're getting a very robust cutoff around those quarters. Most private companies that we work with don't necessarily do a hard cutoff at quarters or a very robust cutoff in quarters. So that can take some time. So when you think about SPAC has a 24-month life to do a deal. And as Ben said really well, if they come to your table and they start talking to you, you don't have all that information ready, they're potentially going to walk away from the deal, given they have to get something done in 24 months. So it's the audits, it's the reviews. Staying on the topic of accounting financial reporting, you're going to have to prepare an MD&A, a management discussion analysis, for the document explaining to the readers why things changed over time. What does your liquidity look like on a go-forward basis? So there's a heavy lift there that most private companies have not done yet. And then another very unique part to a SPAC S4 process is the pro formas that have to get prepared, showing a combination of the SPAC plus the target company, plus the PIPE, plus the variety of other structural changes that may be put in place, all take a lot of time. So making sure that you have the team to do that's where, we play a heavy role in a lot of our non-audit clients, but really being ready for that when you get to the discussion table with the SPAC. The other areas that companies need to think about if they're considering a SPAC transactions, the tax structuring. Do they have the inefficient tax structure in place here? Because this is not an IPO per se. It's a merger that takes you public. So and you think about a merger, what are the tax consequences of that merger for your shareholders, and how can you put an efficient structure in place around that? SOX controls. As a public company, you're going to have to deal with SOX, Sarbanes-Oxley. Have you done anything from a controls perspective? If there's material weaknesses, you're going to disclose that in your Form S4 as well as you go through the process. So starting that process early. And then the other big lift that we see is your compensation structure. What compensation plans are you going to put in place for your employees as a public company? It likely looks different than what you have in place today as a private company. So thinking about that early on, getting the disclosures in your document, setting those plans up, whether it's an employee share purchase plan, RSU plan, making sure you're getting ahead of that. And then we mentioned the governance and making sure that you're doing the recruiting for your board members, because there'll be a negotiation between the SPAC and the target, who's ultimately sitting on the board and representing the different parties. Recruiting independent board members that have the experience, expertise, and diverse can be a long pole in the tent. So starting that process early. So I'll pause there. I'm sure Ben, Rob have a lot of other experiences in addition to that, but those are the heavy areas that I see companies that are thinking about this really focus on their preparation going into a SPAC.
Dave, one thing I think we should raise is the notion of a specialized SPAC versus kind of non-specialized SPAC. And I think it might be helpful actually for you to take this question, not to play the moderator here again, but you're the most expert at this, because LifeSci has done biotech specific SPACs. In Clene's case, we did not merge with a biotech specific SPAC. It was more of a generalist SPAC that didn't have a sense of industry. And so I think this would be a good thing for the audience to have a sense of.
Sure. So SPACs, there's an incredible variety in what SPACs can be. They're not all made the same. You're hearing a lot of them, and that they're coming to the marketplace. I didn't mention the statistics earlier of just the number of SPACs that come out, but the structure of SPACs are different. They have different target industries that they're going to look for, and the management of these SPAC vehicles, have experience in whatever expertise area that they have. And as a result, they will raise money specific to that idea or that industry or that thesis. So in the case of the LifeSci SPACs, 80% of our investors are high quality blue chip names that invest specifically into biotech deals. The reason why they like the SPAC vehicle is that they can do the same type of work that they would do in a crossover round, which would normally be where they would go over the wall, or they'd sign confidentiality agreements. They would get into the data room. They would spend a considerable amount of time reviewing the underlying science, and then they'd come out and say, yes, I like this company. They would invest in a private round, knowing that in 6 to 12 months later, that company would be going public. In a SPAC vehicle, they get to do that same level of work, but now they have the surety that they're going to have a public entity at the end of this process, and that process is, anywhere from 3 to 6 months from start to finish. By the time the investors get involved, it's later in the process. So it might even be 6 weeks or 4 weeks before the deal closes. So it's very efficient on their behalf. For the rest of the SPACs, they're raising money from generalist investors. They might have a thesis in real estate or a geographic focus or something else, and they're just looking for targets that kind of fit that mold. In the event that they're not able to do a transaction within that thesis or mold, then it becomes available for other companies. And in the case of Clene, which went through a generalist SPAC, in the case of DermTech, which went through a generalist SPAC, in the case of Neuropharma RX that went through a generalist SPAC, there's a number of biotech companies that are able to come in, and that's where the pipe, which Ben had talked about, really comes into play, where you're bringing in investors who understand the science, who understand the company. They're investing alongside those generalists. And so part of the structuring and understanding of getting a SPAC transaction done and identifying a SPAC is finding the right vehicle that makes the most sense for all parties. And so it's more of like a dating type of situation. So you want to date with a couple of girls, and then you realize it wasn't right for you, and then you eventually marry the one you like. And that's how it works with SPACs. So yeah, I'm happy to answer any other questions like that if people have more specifics. But I'd love to hear more from our panel. Rob, you threw a question to me. I'll throw one back to you. So IPOs, we've talked about how hard it is. You have to get ready for an IPO. But why would you want? What are the incentives here to do a SPAC? Is it for the sponsor, for the investor, for the management, for the target? And how do they align? And why would I go this route as opposed if I'm already going down that path of going for an IPO? Why, if I'm any of these stakeholders, do I go this way instead?
So back to Mike's point on efficiency and kind of speed to market, I don't think we can de-emphasize that. It's frankly a critical piece, but I want to introduce a new theme that we've not raised yet, which is the valuation construct of the company. A SPAC is really a merger, and there's a negotiated business combination price and a target that the SPAC places on the company that they're looking at. And that target is usually not relevant to what would be required classically with the IPO, which is to say, a crossover capital raise in the institutional marketplace, during which that crossover capital raise may lead to a valuation squeeze on the company. So whereas an investment bank would never take a classical company into an IPO until the crossover raise is effective and finished, and much or a good percentage of the IPO book is already spoken for, that is a different construct than what is required in the SPAC. So in our case, though we had just concluded a few months previous a large raise of 40+ million, effectively a type of crossover, then we didn't actually need to have that structured as a classic crossover. And that raise enabled us a bargaining chip in the conversation with the SPAC themselves as we talked about what the valuation for Clene should be. So it's more of a dialogue, whereas the market may set an IPO price driven in large measure by the crossover capital institutional folks. In a SPAC's case, the SPAC sets the price and the company negotiates with the SPAC about that. So I think, Dave, to your question, if you're ready to go to market, you've got cash on the books already at the company, you can more speedily get to market through a SPAC vehicle. You can organize the private investment into public equity, the pipe that would be, parallel to and sit side by side the SPAC. Then I think in lots of cases, there's many synergies that are advantageous on balance to the SPAC route.
Excellent, great, thank you. We talked a lot about what the benefits are now. Are there risks associated with this? Ben, as legal counsel, what do you see are some of the main legal issues that would arise by going through a vehicle like this?
Yeah, sure. I'll start that by kind of following up on the last discussion. Another critical component that we have to consider when we're also looking at the SPAC as a company is considering a SPAC to merge with is remembering that these SPACs have they're only good for a 2-year period of time. They have expiration dates on them. Most of them are 2 years. And as a SPAC gets further and further into their life process, as they start getting closer and closer to that 2-year expiration date, they start getting, especially the sponsors, start to get a little bit desperate because these guys have put up millions of dollars of their own cash. And if the SPAC transaction doesn't happen, while the IPO investors can get their money back from the trust The sponsors don't have any claim to that trust. They waive that any right to money in the trust. And so if a de-SPACing transaction does not take place, the sponsors have lost all of their investment. And that can be an important negotiating leverage point for a potential target, knowing that that the sponsors that you're negotiating with, they stand to lose millions of dollars if they don't come to some type of de-SPACing transaction. And I think certainly in the Clene case, Clene was able to take advantage of those realities as well. So that's one of the risks, certainly for the sponsors, as they engage in the SPACing process and putting up a SPAC and looking for a target, is knowing that they have this drop dead date ahead of them. For SPACs themselves, or for the sponsors, sorry, for the targets themselves, it's important to remember that this is at the end of the day, this is a merger transaction. And so you do have to make sure that you're complying with local laws. It is a public M&A transaction, and so there's two important components. There's the local merger portion, where you could be a Delaware entity, and then the SPAC could be Delaware, in which the entire process is governed by Delaware law. We're seeing more and more SPACs set up as Cayman entities, for example, in the Clene case, Clene merged with a BVI entity in its de-SPACing process, and so you need to get a local BVI council or Cayman council, or wherever the SPAC is set up. They're going to have to be involved in that process as well. There's not necessarily a lot of risks. We can figure that out, but it is certainly something to keep in mind going forward. And then, of course, there is this whole SEC review process. You're preparing to be a public company, and so there's risks involved with that process. As you open yourself up to public scrutiny, you're going to start making public filings. Your material agreements that previously hadn't seen the light of day are now you're required to publicly file those as exhibits to your S4 registration statements. And so there's just the whole process of becoming a public company has risks involved that as a potential target that you need to be aware of. They're not dissimilar, I think, in a lot of ways from from a normal IPO process, but it is something that you do need to be aware of.
Yeah, if I could just piggyback off what Ben said, I think that the risk on that last point around public company readiness is, from the target's perspective, these move quickly. When you do a traditional IPO, you're in the control of your own destiny. You can chart that course out with the SPAC because it is an M&A, and there's a completely separate independent party on the other side of that's pushing you to get the deal done. The speed at which these moves, it can be a benefit, but it can also be a risk. And are you really ready by the time the de-SPAC to flip the switch and act like a public company, be like a public company, hit the reporting deadlines that are set by the SEC, to the extent you're generating revenues, project your earnings out there and talk to the street around there. So these happen fast, and that's where, again, from the finance seat, where we see the biggest risk is the ability to stand on their own as a public company.
And picking up on Mike's point about projections as well, one of the advantages / risks of the de-SPACing process is that especially as you start talking with PIPE investors, they're expecting to see projections, especially if you're a young biotech company and you haven't had revenue yet. Dissimilar from the IPO process, in which, largely driven by lawyers and concerns, we're very careful not to include projections. In the SPAC process, projections are an important part, because the PIPE investors are going to expect to see them, and you're able to provide those to PIPE investors. But at the same time, you're going to publicly disclose them. So the process normally goes, you prepare a deck, you present that deck to the PIPE investors, and then shortly after the merger agreement is signed, the SPAC files that deck publicly with the SEC. So your projections are out there, which can be a good thing if you want the world to see your projections. But there's also obviously considerable risks involved with making projections about your company going out there, especially if you're preparing to be a public company and shareholders are going to start to have, potential claims against you about the things that you publicly disclose.
Excellent. Mike, I think you've touched on a lot of the de-SPACing process. Maybe we'll jump forward, and I'll stay with Ben here. Can you describe, Ben, some of the typical negotiation issues that might arise between a sponsor and a target?
Yeah, obviously, price and valuation is obviously going to be the big one, right? What is my company going to be valued at? Some of the others, we've hit on, what is the role of the SPAC going to be going forward? How many people, what's the board going to look like? Is the SPAC members, the sponsors, are they going to have a seat on the board going forward? Do they want to have a seat on the board, or are they happy to just, complete the merger, get their shares in a new public company and get out? So those are important ones. Also, we're increasingly seeing, it's a great time to be a target if you're considering a SPAC, because there's more SPACs being put up than any time ever before by a considerable margin. And so we're starting to see companies, the new term coming up is a SPAC off. We're starting to see, good target companies have multiple SPACs approaching them, and they're able to negotiate against them. So, one of the things that sponsors are willing to do in order to make themselves more attractive to a potential target is they're willing to give up some of their sponsor economics. They're willing to give up some of their warrants in particular, because when a SPAC does its IPO, the sponsors both receive shares in the SPAC entity itself, but they also purchase a large number of warrants. And the purchase of that warrants is cash that they use to pay for things like underwriter commission, as well as the SPAC's working capital going forward. But that can be a large overhang and very, unattractive to a potential target to have all those warrants out there that eventually, assuming things go well, will convert into stock and dilute the rest of their shareholders. So we're seeing that increasingly as being a negotiation point. Is, what are the sponsors willing to give up of their own economics in order to make this deal work?
Great, thank you. I'm cognizant of time. I know we want to open up for some questions. I have some more I can go through with you guys as well, but I want to let all of the attendees know that they can go ahead and start submitting questions, and then I can start pulling them up and ask on your behalf to the panel. So I have a couple in here right now. I have 3 so far. So why don't I start with those, and then once we hit those up, we will have a little bit of time left. I can ask some follow-up questions if necessary. But the first one we have right now is, are SPACs purely motivated by the financial statements, and how prepared the controls and books are? Are there investment, or is there investment that these SPACs have similar to strategics?
I'll jump in there, David. I think the financials are an important part because they're required. So when we talk about the timeline to get the PCAOB audits done, to get the interim reviews done, to get everything that needs to be done for the regulatory filing, that S4, that proxy statement, it's required. So when we say SPACs are very interested in the financials, that's one aspect, is do they have the ability to drop those in fairly quickly once they negotiate the terms of the merger agreement? For some companies, depending on the financials and the story, and especially the forecast and the projections that we spoke about, that's going to be a big part of any story. When are you going to hit the revenue? When are you going to meet certain milestones out there? That's going to be a bigger part probably of the story. We're seeing a lot of pre-revenue companies, in various sectors go out. So those financials are pretty benign. There's not a lot in there. It's more about the story, the growth, how are investors going to make money off of the growth of the company as they mature through it. So financials are very important for those reasons, I would say.
Excellent. Next question from the audience. Is it less expensive to do a reverse merger than a SPAC? And how would you contrast the two?
I'll take a gamut at that. I think expense-wise, I don't know that there's a big difference. I think the big difference between a PIPE and a SPAC and a reverse merger is that with a SPAC, you have a company that's specifically set up with this giant pool of cash to conduct this type of transaction. That's what it exists for. And so when you merge into a SPAC, not only are you getting the benefit of becoming a public company, but you're also potentially getting this large pool of cash either from the pool itself within the SPAC or in the PIPE transaction, as we talked about. In a traditional reverse merger, it's much more dependent on, there's a much larger variety of what that third party is going to look like. It could be a publicly listed company that is struggling and has very little assets, and it's the only thing it has going for it is the fact that it's a public company. In which case, you merge into them. You might be able to do it for a better valuation. You might have better negotiating leverage, but they're not going to provide you some of the potential cash and upside that you might get from a SPAC transaction. Or it could be another company in which you have a lot of synergies with, and which you're going to get a lot of advantages by merging with them that aren't there with the SPAC. A SPAC is nothing but a pool of cash, so there's really not a lot of synergies involved with the SPAC. It's just really a listing decision that hopefully has a large amount of money that comes with it.
Great. Another question from the audience: does it matter if the SPAC is on NASDAQ or NYSE? Does the exchange actually play a part in understanding or the deal terms or anything like that?
No, not really. I mean, we've seen both the NYSE and NASDAQ. A few years ago, everyone was afraid of SPACs. They were kind of they were looked down upon, the transaction for losers in some ways, and so both exchanges had put up some walls to make sure that these transactions weren't going to be detrimental to shareholders. But as they've become increasingly accepted by the market, we're seeing both NYSE and NASDAQ kind of come together on their rules, making them simpler, so that the de-SPACing transaction can go forward more simply. I think the real question is where do you want to be listed? Generally we'll see biotech or other tech companies prefer NASDAQ, whereas more traditional companies prefer NYSE. So of course that's not always the case by any means.
Great. Are there any control issues with merging with a SPAC?
I mean, I think when you look at the SPACs to date, about 80% of the transactions out there, the SPAC itself does not take control of the organization. And in those cases, the majority of those, the minority interest, they're making an investment, and the target has significant rollover equity in the go-forward business, and it's really treated as akin to an IPO from an accounting perspective. Cash is coming on the balance sheet, and you're recapitalizing the equity section. So most SPACs, there's not a change in control, and the management team stays in place at the target company. There's a negotiation among who's sitting on the board. Typically the target, in those cases where they have the majority of the economics and the voting rights, appoints the majority of the board members out there. So you don't see a change in control in most of these transactions. When you do have the change of control, that other 20% of deals, it's almost akin to a private equity transaction where from an accounting perspective, there's a step up in the basis of the assets. You have a black line presentation, your financials. But even in those situations, there's still a negotiation of who's sitting on the board, who's the management team on a go-forward basis. Typically, what I've seen, the management team, they know the business, they have the history there, they're driving the growth, they're a big part of the story. They stay in place. It's more around the board representation on a go-forward basis.
Excellent.
And actually, Dave, I think we should just add a point to that. So in our case, we were the 80% of the category, and the day-to-day operation of Clene has changed effectively not at all. The SPAC is effectively, in our case, completely irrelevant other than the fact that they now are a minority shareholder. And so this has been a big advantage because Clene is able to execute its mission, its strategy, its business thesis exactly as we planned before. So in that respect, it's as if it was an IPO.
Yep.
Great. One more question from the audience. When a typical banker-led IPO is done, the company generally will have analyst coverage. No guarantee that it'll be good coverage or who's covering it. I assume you don't get this with a SPAC. Analyst coverage is always debatable, but is not having it an issue, or is it something that should be considered? Rob, you've
Yeah.
been dealing with this.
We've been dealing with this, yeah. So this is actually one of the risks of the SPAC as part of the de-SPAC process, is that for the period of time after the SPAC transaction, there is a de-SPAC journey, and part of this is most SPAC shareholders, they have a warrant, they have a right, and they have a share. These come into the market during the first period of weeks. The company is in somewhat of a quiet period. There's no analyst coverage. And so you have to deal with the market being very volatile for the company's trading platform for, in our case, about the first month. During that process, you had to go out and get analyst coverage. And I would argue it's critical, essential, necessary, and as much as you can. So this has been a journey for us. We presently have one analyst covering Clene, but we have 4 or 5 that we're anticipating to cover us within the next few weeks, actually, to next few months. And we've had constant active dialogues with these analysts. So the advantage, though, is that once we start this process, then the company gets much more well known than it was, as a private company. And there is demand for the stock, and the volatility settles out and even takes you to a different benchmark. So that is something the company needs to be prepared for in any SPAC transaction, is to expect volatility right at the beginning, and that one needs to move aggressively into a whole series of different conversations that you might not be used to having, which is analyst coverage, which is more investor meetings as a public company than I ever held as a private company. And that was a bit of a learning for me. I didn't appreciate that I would spend most of my day talking to investors, as I am at the minute, during this volatility period.
Great, thank you, Rob. Unless we have another question from the audience, I'll follow up with one more. I know we have about 2 minutes left in the panel. So everybody on this panel is been part of a SPAC deal, in various forms. What are some of the lessons learned or words of advice that you would give to those that are considering either going in as a target or putting together their own SPAC going forward?
On the target side, I would say that preparation that we emphasized through the conversation today, start early. If you do think there's going to be a public exit, start thinking about your auditor, start thinking about those financial statements, start thinking about systems and headcount. Do you have the right folks on your team to really be a public entity on a go forward basis? I don't think you can ever start that early enough and really bring that muscle memory to the organization, because again, I go back to the speed at which these have moved. And making sure you have the team that's ready there, because in addition to the filing, you're going to be doing the investor roadshows, you're going to do diligence, et cetera. So there's going to be a lot on your team's shoulders. So make sure that you have the right team behind you.
Great.
From my point of view, I would say just remember that the market is fair. In terms of, you might be able to negotiate with your with a SPAC a better price than you would be able to negotiate with investment banks through an IPO process after they've done diligence, et cetera. But once you're publicly traded, once all of your information is out there, once investors are relying upon that, the valuation that you negotiated at that time is going to settle where the market thinks it should be. So the market is fair. Things tend to work out. You get the valuation that the company deserves, whether it goes through the IPO process or whether it goes through the de-SPACing process. And that holds true for SPACs as well. I mean, right now we're seeing a pretty frothy market. We're seeing, a company goes out with their SPAC IPO, they're selling it at $10 per unit, and before long, in some instances, these things are trading at $13, $14. That's obviously not going to continue. That logically doesn't make a lot of sense. There is going to be a resettlement at some point, because over the long haul, the market is fair.
So I would add to both points, be prepared for the heavy lifting that's required to do all of this. It's no small task. A SPAC is not easier than an IPO. A SPAC is more efficient in terms of time to market for an IPO, but the same elements that you have to satisfy the SEC with are exactly the same. The board still needs to be aligned to the frothiness that Ben's just spoken to and be prepared for it. And the company needs to expect that the investment raising activities that one did before are going to be afterwards, possibly even on overdrive. But taken together, for Clene, it was still a fantastic decision because it took us to the public markets, which opens up a whole different lever of fundraising opportunities, not earlier possible as a private company. And if you're planning public anyway, a SPAC, I think, is a useful vehicle, and we indeed have benefited from such a path.
Well, thank you, Rob, for concluding the panel there. I want to thank everybody for joining us, all of our viewers from around Utah or around the globe. Our experts have really helped us better understand what SPACs are all about. I've really enjoyed this discussion. I hope you all have too. Please continue to sit with us and join us on the next panel presentation on early stage investing. Please feel free to reach out to us via BioUtah and BioHive if you have additional questions. Thank you so much for taking your time today. Thank you, everybody.
Thanks
Thanks all.